Hello everyone. Let us understand about international aspects of capital structure in this session. So capital structure, like the proportion of debt equity mix, that is basically the simple thing we can understand about this capital structure. See how much proportion equity should be there, preference should be there, and borrowings. Okay, so all these things. So how we are just structuring. Okay, so that ratio, that proportion is actually called as capital structure. When it comes to international aspects of capital structure, so where it involves how multinational corporations and domestic firms, they are raising their capital internationally. See, domestically that we know, internally that we are just raising capitals. Okay, so through the lenders inside domestic area, or the banks. Okay, all these things that general we know. Okay, when it comes to international capital structuring, so where it includes how internationally they are managing their debt and equity. Okay, so there are certain factors like currency risk, yes, tax implications, and market conditions also. It differs from country to country. So these are all the different factors that we need to consider when internationally we are doing any transactions. That capital structuring is what made. Okay, so next, see here, in 1970s and all, there was, the massive cross-border capital flows between country to country. So 1980s, still though that period, so predominantly debt capital in the forms of bank loans and bond issues. Only these two, or the focus areas, like only through bank loans or through bond issues. These two were only available in those period. Okay, and 1990s and all, equity related to capital flows, that it was emerged. Okay, that is new issue of equity capital, that is through IPOs and depository receipts available in that period, and even convertible bonds, certain things at all. And MNCs, it was mobilized, have low cost of capital from different markets. Okay, obviously that has to reduce its cost of capital. Okay, so cost of raising the capital also, there are certain difficulties when we are doing any cross-border transactions. That time it was difficult. Okay, even now too. And yes, key international aspects in the sense, see, first one is raising capital abroad. That is the first aspect we can consider. So domestic firms may seek foreign debt or equity to access cheaper financing. That is the reason for getting the cheaper financing. Because of that, seeking towards foreign debt or foreign equity. Okay, because there might be several reasons. Currency risk, we can say, foreign investments, we can consider. So all these are different reasons. And next is MNC subsidiary financing. Okay, so where these MNCs, they actually faced different decisions on how to finance their foreign subsidiaries. Okay, like parent company versus local norms and tax implications, local market conditions. So these are all the different factors when it comes to this subsidiary concept. Currency risk management, in the sense, currency value from one country to another country, it differs, and we all know, because of that, several reasons, the value of assets and liabilities, currency fluctuations. Okay, so there is a concept called as hedging. So all these things, acted as the next aspect of international aspects of capital structuring. And next is tax considerations. Okay, corporate tax rates. Okay, increasing and decreasing of tax rates in different countries. That also affects the capital structure, particularly optimal capital structure. And political and economic risks, yes, definitely, instability of political, things and all, and changes in economic policies, definitely this risk, no one can escape from this. And agency cost in the sense, information asymmetry and difficulties. That is the, major cost for this agency cost. That is the major reason we can say, okay. And access to capital markets in the sense, different countries, that efficiency is what missing. Okay, that efficiency, how they are just procuring their cash fund. That is what a major thing, that they are just losing out all these things and all. And ownership restrictions in the sense, so certain restrictions on foreign ownership of domestic companies. So that also acted as, affected the cost of capital, and we can say that reason too. And factors influencing MNC capital structure, stability of cash flow, we can say credit risk, okay, that is the credit worthiness of the firm, okay. And next is access to, retained earnings, agency issues, all these things we discussed, right? And interest rates and exchange rates. Okay, so tax rates and regulations. So these are all the different factors influencing MNC capital structure. Okay, so doing internal capital structure itself sometimes difficult, and imagine that if it is international capital structuring, we need to face so many difficulties, especially currency risk, tax, political instability, all these things, okay, exchange rates and all. So definitely that might be risk. And obviously, on the other hand, it gives good return also, in case if you are managing in a proper way. Hope you all understood. Thank you.